Welcome to Beavers Wealth Management's October 2024 edition of Let's Talk Markets. You can tell it's October because I'm a few weeks early for Halloween, but I figured this was an appropriate jacket for this month. As I've said before, it's our goal to continue to grow Let's Talk Markets with the intent of educating and empowering the families and businesses we serve. So if you know of anyone who may find this information valuable, please feel free to share it with them. And I got to tell you, we have got a great show for everyone joining us today. But before we dive in, I wanted to share some exciting updates with everyone. We are streamlining Let's Talk Markets to bring you more concise, information-packed insights in a shorter format, while still delivering everything that you expect with our Let's Talk Markets. But we wanted to remind everyone listening today, we're incredibly excited to introduce our new Between the Bears and the Bulls podcast, where we're going to discuss the pursuit of excellence, business, the economy, and everything in between. In our most recent episode, we actually sat down with an economist to discuss potential outcomes from the upcoming election and how they could affect our economy and markets moving forward. And so we cannot wait to share this conversation with you, so please stay tuned as we are getting ready to release this episode on our YouTube and Spotify pages very soon. So we'll send that to you here before too long. Okay, but it's Let's Talk Markets today, and so what are we going to discuss? As we typically do, we're going to take a quick glance to the past, and we're going to look at what happened this past month in September. As I had said, remember, historically, September was a pretty bad month in the market in a presidential election year. Well, was that the case this last September? We'll see. Then we're going to take a hard look to the present and take a look at what investors are keeping an eye out on for this month of October. Can y'all believe it's the fourth quarter of this year? It's been like that, how quickly this year has passed. Now, a recap of the past month to start us off. September is typically the weakest month of the year for stocks, like I just mentioned. But thanks to the much anticipated federal funds rate cut, the S&P 500 turned in its first positive performance in a September since 2019, achieving its 43rd record high of the year. That's a lot of record highs. I've said it before, you get a record high and you get a record high. Every day seems to be a record high. We like it here so far. The Federal Reserve is recalibrating policy, and we are likely to see a series of rate cuts over the coming months as it gets closer to neutral, which is ultimately market friendly. This coming from Raymond James Chief Investment Officer, Larry Adam. Now, the Fed took a bit of an unusual, but not unentirely unexpected step, cutting interest rates by 50 basis points or 0.5% rather than the usual 25, and is on track to successfully navigate a soft landing for the economy for the first time since 1995. And the economy is showing resilience, right? The labor market remains stable. Inflation appears to be on a better path. And we're going to get into a little bit more of the details shortly. But I first wanted to take a look at the numbers that we've seen year to date within the markets. And so what's interesting to me is if you look at the three main indices, right? The S&P 500, the Dow, the NASDAQ, their year-to-date performance, double digits. I mean, we've seen the NASDAQ obviously focusing more on the tech space, up 21% this year. Who would have thought in a presidential election year that we'd see the NASDAQ after what we saw last year and a great year, up another 21% as it related to technology stocks in between. Now, what are the top three sectors? I always like to see what the top sectors of the economy are and what the three worst sectors are. Not a whole lot of surprise from what we've seen in previous Let's Talk Markets, but utilities top out at 31% up year to date. Communication services also up 30%, and technology up 29%. Those are our top three sectors of the market. Our worst bottom three sectors of the market, believe it or not, even the bottom three sectors of the market all are up double digits. Real estate up 11%. Materials and healthcare both up 12%. And those are the bottom producers. Now, if you look at kind of the other aspects of the market, Fed funds target rate is now at 5% after the latest pullback, or rate cut, excuse me. And in inflation, actually at 3.2% is the number that came in. Remember, that doesn't mean things are getting cheaper. That still means things are increasing, but at a much slower rate, at 3.2%. Unemployment at 4, just ticked over 4%, which is higher than it has been in the past from what was a historically low unemployment rate. And GDP right at 3%. So obviously been a really, really positive 3/4 of this market year. Okay, now, one of my favorite things to do now in Let's Talk Markets is looking at Ryan's market fact. And so Ryan has termed this market fact the battle at the ports. Now, as many of you probably know, nearly 50,000 dock workers from the International Longshoremen's Association walked off the job on October 1st, 2024, affecting up to 49% of all U.S. imports and halting 34.3 billion in goods on the first day alone. I mean, there's a ton of things that go into this, but look at the retail and tech vulnerability. Companies like Walmart, IKEA, and Samsung are among the most exposed companies, with Walmart importing nearly 48,000, remember this, 48,000 20-foot equivalent units through affected ports in the last year. And so you're probably sitting there wondering, what in the world is a 20-foot equivalent unit? Well, for those that are unfamiliar, that is a standard shipping crate. So you can see how Walmart is using thousands of those shipping crates and how much just one day of them striking has done that. Now, there's also risk in the auto industry. Auto manufacturers like Hyundai and General Motors, along with major tire companies such as Goodyear and Michelin, they are incredibly sensitive to supply chain disruptions. Now, what about the wider economic impact? The port shutdown significantly impacted perishable goods like bananas. At 75% of U.S. banana imports actually flow through the impacted ports. A little bit of a fun fact for you in all this. Walmart's number one most sold item, what do you think it is? It's the banana. That to me is a bit bananas. Now, the strike resolution. The port strike ended on October 3rd, 2024. So I'm pretty decent at counting. I think that's 3 days of striking. It started October 1st. It ended on October 3rd. It wasn't a huge strike after a tentative agreement was reached. While work has resumed, negotiations on other issues, they're still ongoing, right? The backlog created during the strike could continue to affect supply chains in the coming week. So let's take a quick look at this chart. It's interesting to see which publicly traded companies are most sensitive to disruptions at the ports. And you can see what was so interesting is obviously the number of those TEUs that we talked about, 47,000 of those particular crates were used by Walmart. IKEA, the second highest at 42,000, Samsung at 33,000. What's interesting to me as you kind of go through this, you can see the companies that were significantly impacted. Most of these companies have some component of furniture. We've talked about this in the past, but the idea that furniture, so much of what we utilize today in the US from a furniture standpoint, is actually imported. And so they're coming through these different crates. Now, what I will say is for all of those who got a little nervous when they heard about that and ran out to the grocery store to stock up on toilet paper, let me assure you, most of the toilet paper that we use here is actually manufactured in the United States. So that wasn't an issue, even though I know last week when I went to the grocery store, the whole line of toilet paper was gone. So that gives you a little bit of idea. It wasn't as big of a significant impact on the markets because that strike only lasted 3 days. All right, so now let's talk a little bit about what investors are visiting about this month, in the month of October. And so the first thing that we'll look at is the U.S. economy continuing to normalize. After last month's surprising downward revision to employment numbers spanning from 2023 to early 2024, non-farm payrolls for August were worse than expected at 142,000 new jobs. Now, don't get me wrong, that's still strong compared to historical averages, but a signal that the U.S. labor market is continuing to normalize. The job openings report was also lower than expected, and June's numbers were revised lower, bringing job openings closer to pre-pandemic levels. Now, at the same time, unemployment ticked down to 4.2% from 4.3% in July. So even though it's a little bit higher than what we've seen in the past, it actually did come down and tick down a little bit in July. The services sector continued to expand in August, helping reduce market concerns about the strength of the U.S. economy. We know manufacturing has struggled, but lower interest rates may help the sector out of its slump. Housing starts and building permits were higher than expected in August, and builders, they've accelerated completions, which increased by 9.2% from July to August and 30% year over year. So you're seeing a lot of new buildings happening as it relates to the real estate play, homes. And that has been an issue, and we've talked about this for some time, that there's just been not the correct amount of supply of homes for what we've seen from a population growth side of the United States. And so we were undersupplied for some time. Really good to see that 30% increase year over year. Now, the second thing that we're looking at this month, market leadership continues to broaden. And so while large companies continue to gain in value, small and mid-sized companies saw the strongest returns for the month, underscoring the importance of maintaining a diversified portfolio, which is key here. The technology sector is still settling following an outsized performance earlier in the year. While interest rate sensitive utilities and real estate sectors, they're enjoying their time in the limelight, finally. Now, two out of favor areas finally have started to perk up in the last week. And we talked a little bit about this, but consumer discretionary, thanks to the Fed's rate cut, and materials because of China's strength due to policy. We can also see this play out by looking at this chart below. And what's interesting is as the market rotated out of overvalued and overextended large cap AI growth stocks and into undervalued value and small cap stocks, returns have broadened out all across the market. And so according to an attribution analysis of the Morningstar US Market Index, as of September 23rd, the returns from 10 stocks accounted for 50% of the total market return year to date. Now that sounds like a lot, right? 10 stocks, 50% of the total market return. And I said, okay, it only accounted for that. Well, those same stocks accounted for 67% of the market return as of June 24th. So now it's only 50%. As of June, it was 67%. So what you can see is the rest of the market is finally starting to keep up. And that's why you can see this particular chart shows you each of those individual stocks and how it's related to overall market performance. Okay, another thing on everybody's mind this month, third thing, long-term yields, they're up, and short-term down following the rate cut. So short-term rates down, long-term yields up. And this is to be expected, right? After the Fed's September rate cut, the latest Federal Open Market Committee, that's what they call the FOMC, signaled an additional 50 basis points in rate cuts by the end of the year, or 0.5%, and another 100 basis points, or 1% in 2025. Intermediate and long-term Treasury yields ultimately rose following the cut, steepening the curve. And as expected, short-term yields fell in the lead up to the rate cut, and the days following, the one-year yield actually fell 73 basis points since the beginning of August, while the 10-year yield is down about 21 basis points. Bloomberg calculations, they're estimating another 75 basis points of cuts across the FOMC's remaining 2 meetings this year. So remember, the Fed's going to meet twice more, and we're thinking it's going to be a 50 basis point rate cut and a 25 basis rate cut before end of year. Another 75 basis points. Muni to Treasury ratios are near their highest levels of the year, with the 10-year ratio at about 70% and the 30-year around 85%. So I know a lot of numbers there as we kind of go through. I think the bottom line from this is we ultimately know that interest rates are on their downward swing. And we've been calling this for some time, but that's kind of what we've seen and a lot happening within the last 30 days as it related to the Fed. Now, another thing that people are thinking about, the fourth, the utility sector has soared. So as the Fed cut interest rates and the 10-year Treasury yield came down to 3.7% in September, investors began to feel a little more comfortable about companies that are more reliant on external funding. The utility sector, which is famously rate sensitive, as we know, set an all-time high last month, surpassing the previous high from 2022. Utilities and independent power producers, they're also benefiting from the sentiment surrounding the AI boom, given that the data center build-out is starting to provide a meaningful boost to electricity demand. So we've talked about this before, and that we were going to see electricity and other types of energy increase the need for that because of this AI boom. And you can also see, looking here at the chart, what all of those sectors and how they're playing out within the markets. You know, financial services, they have also outperformed this year as the market anticipates net interest margins will expand as the Federal Reserve embarks on an easing monetary policy. Now, laggards include the energy and basic material sectors, both of which are expected to feel the brunt of the slowing rate of economic growth over the remainder of this year and into next. And we knew that was going to be the case moving forward. Okay, so that's four things that's coming this year. I got another one for you. Number 5, an important legislation excluded during what they're calling China Week. So while the House of Representatives spent significant energy on China-related policy earlier this month, several impactful and long-anticipated pieces of legislation were excluded from the votes. So among them, provisions that would apply further scrutiny of U.S. investment into key Chinese tech, placing new restrictions on data centers, and reform the abilities of Chinese companies to import products into the U.S. duty-free via de minimis exemptions. Now, September also saw fears of a government shutdown that were averted, with Congress passing a compromise clean stopgap bill that funds the government through December 20th. Legislators will now be directing their attention to the annual defense policy bill. So we're at least open until December 20th, right before Christmas. So I got a feeling this isn't the last you've heard about a government shutdown. Brace yourself. Okay, also, for number 6, lots going on this month and in this quarter. The ECB cut rates and the UK holds them steady. All right, well, that means the European Central Bank, the ECB, cut all regional rates in September, a necessary move, according to the president, Christine Lagarde, because adjusted forecasts, they showed inflationary pressures decelerating further over the bank's 2-year time horizon. Lagarde stressed that regional commercial bank lending conditions are still restrictive, and they expect to remain so for the near future. But in contrast to the European Union, you saw the UK's Bank of England, they maintained the country's base rate of interest at 5%. It's where the US is right now, voting by a wide 8-1 margin not to loosen monetary conditions for the second time in as many meetings. Now, following the backlash against this decision to raise interest rates in July, the Bank of Japan, on the other hand, voted not to raise them again during its September rate-setting meeting. So what's interesting is kind of all over the world, you're seeing different policies, right? The US cutting and the ECB cutting. You've got England staying. You saw Japan just a few months ago that were raising. Interesting to see that monetary policy across the globe is in different places. Now, the biggest news across international markets, though, this month was the People's Bank of China. They announced a broad stimulus measure in the country's latest effort to halt persistent weakness in the real estate sector. They call it the PBOC, confirmed that it will set up a facility providing stockbroking firms, investment funds, and insurance companies access to central bank liquidity, specifically for the purchase of domestic equities. All right, so like I said, there is a ton of jam-packed information in this and a lot of data. But what's the bottom line? Well, while it's good to see the broadening of the market and the lowering of interest rates, that excites investors, plenty of variables could spark volatility in the weeks and months ahead, including the health of the economy, employment, and the Fed messaging. Not to mention we've got an election within the next 30 days. Now, we've navigated through many market cycles over the past few years, and yet the markets have proven their strength. The key takeaway from Beavers Wealth Management is that navigating these waters successfully means being in the right places with the right strategies. And that's why we offer our second opinion service. If you or someone you know could benefit from a second set of eyes on their investments, we'd love to help. Ensuring that you're in a good spot with your investments is our top priority, and we're here to support you and those important to you every step of the way. Okay, so as I said, a ton of information in today's Let's Talk Markets, but what did we cover? Well, we recapped the past month of September, examining kind of what's been happening in the markets over the course of the last 30 days. And then we discussed the key market developments that investors are watching closely. There were a ton of them this quarter, as they're expected to shape future market trends, something we're going to be looking at over the course of the remainder of the year. We so much appreciate you joining us today, and we're truly grateful for each and every one of you. And so if you've enjoyed today's content, we're going to have all of these replays of our Let's Talk Markets. They are now posted on our new YouTube page. And then we have a video podcast format is on Spotify. So please share with anyone you know who may find this information valuable. Also, and what we've been really excited about is our upcoming podcast Between the Bears and the Bulls. And so stay tuned over the course of the next couple weeks as we plan to release our very first episode in just a few days. Enjoy the spookiest month of the year, and we'll see you in November for our next installment of Let's Talk Markets. Oh yeah, and don't forget, leave it to Beavers.